So let's start with the simple model of buying a house. So the blue guy owns a house, the red guy needs a house. So in a primitive economy, the red guy just gives him money to buy the house. Right? He just pays cash. Now, in the more modern era, we have a bank, and this guy can go to the bank and get money to pay for the house. So the bank will give him the money, and the bank will write up a contract, which you know the contract is called a mortgage. The typical terms of that mortgage before the Great Depression would be a 20% down payment. So the loan to value would be 80%. The mortgage term would be very short. It would just be 3 to 5 years. So you can see how this would create tremendous downward pressure on housing prices. So now fast forward to the 1980s, 1990s, and not only do we have Fannie Mae securitizing these small mortgages into larger mortgage-backed securities, we also have private banks and private brokers who are doing the same thing. So this part of the drawing represents another private bank. So let's review a little bit what's going wrong here. In the basic economy, the red guy is responsible to pay the local bank the terms of the mortgage. The local bank assumes all the risk. The way the economy works nowadays is the risk has been shifted from the local bank to FHLB, because the local bank is loaning out money from the FHLB. The risk is also shifted to FHA in the sense that the local bank has taken out insurance to pay off the defaulting mortgages. The risk is shifted even further in the sense that the local bank can sell the mortgages to a private bank or to Fannie Mae. Another one is Freddie Mac. It functions just like Fannie Mae. AIG is an insurance company that sold credit default swaps to Lehman Brothers. The credit default swap functions as an insurance policy. In the event the interest payments to Lehman Brothers from the mortgage-backed securities are no longer paid, they can replace that income with the income from the credit default swap. Again, when this guy stopped paying, these payments stopped going to the investors who bought this mortgage-backed securities. So from this lecture, I want you to understand the government had a historic role in setting up the housing market for crisis. And we shouldn't ask the question, why did the market crash when it did, the housing market? Really the question we should ask is, why didn't it crash much sooner?